Hey, Sean Devlin, the mortgage shoes man, 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 shoes man. Hey, Sean Devlin, the mortgage shoes man. Hey, Sean Devlin, the mortgage shoes man, coming at you with two for Tuesday. Go. Guess what time it is? It's tax season. So, do not call any CPAs now. Now's a bad time to do that. However, now's a great time to be educating your clients about taxes, about how things work. So what I'm going to do is I'm going to talk a little bit about today two different guidelines that I think you need to know when it comes to taxes, okay? So first things first, I got a list. You know it's juicy when I got a list. Here we go. All right. So what is called 2106 expenses. Some of you guys know this, some of you don't. If people are W-2'd or 1099, sometimes there is 2106 expenses on the 1040. And it's where a lot of people would write off like uniforms and things to that effect. W-2 typically, okay? Now, if their income is 25% or less commission overall, then there's no reason why you need to even take it in consideration. However, if that client is majority commission, like the bulk of their income comes from commission, well, you're going to want to educate them. Look, the more stuff you write off and itemize on your taxes on that 2106 line 21 is, or form 2106, you end up deducting from your purchasing power, if that makes sense. So you want to educate your clients a little bit. Now, when it comes to self-employed borrowers have a lot of misconception on how this stuff works. And it seems like the CPAs have a stronghold in the financial arena sector, and the clients will absolutely take their advice. However, there seems to be a definite, I don't know if you want to say bridge that's just missing, because the CPAs do their job really well and they lower the client's tax liability. But what they're really doing is really affecting the client ability to purchase a home or do a loan because they're taking away so much, or they're putting certain things on certain line items that deduct their income. So let me explain. On a, like a schedule, it could be Schedule C, Schedule E, to when somebody's self-employed and they're doing their schedule, a lot of times you'll see people try to break down meals and entertainment. No. When it comes to tax liability, does it lower your tax liability? Yes. But are you really going to have that much? Sometimes I can tell you I've run across loans where the meals and entertainment broke the deal. So just stay away from it. It's not worth an additional $3,000 or $4,000 efforts not to pay the IRS. What you're really doing is, when it comes to calculating your income, when you have a self-employed borrower who's writing off a bunch of meals and entertainment, it's subtracted from their total income calculation. It isn't added back in. So what is added back in are miles, are depreciation. That's a big one. So if you have a lot of equipment, trucks or anything like that, buildings, depreciation, vehicles, and the miles that you drive. If you own your business, those are things that are good to put on your taxes, because not only does it lower your tax liability, but you're able to add it back into the income calculation. These are the things that sometimes the loan officers and the CPAs got to have a connection with. Educate your clients. Start talking about this stuff. This is the time to do it. We'll 2 for Tuesday. Hopefully you got some juicy stuff out of it. All about tax season. Woohoo! You can file taxes as of Monday. Have yourself a wonderful day. Share, interact, like, repeat. Sean Devlin, Mortgage Youth Man, chiming in. 2 for Tuesday. Have yourself a wonderful day. Sell well.